Good morning. Welcome to the morning market briefing. Today is Thursday, June 11th, 2026. We're going to be talking inflation, more inflation data today. We're going to be talking, I had the good opportunity along with Thomas, who's been on the call, Ryan, Tom's protege on the fixed income side, and Mo on the analyst side. We all went to the Rieder, the head of BlackRock's fixed income. He manages $2.5 trillion. And so we have some takeaways from that. I also wanted to talk a little bit about some of the equity issuance that's been going along and why I do think it's significant that they're issuing equity and not debt. And so we'll talk about Oracle as well in connection with that. And then finally, I'll give just a few thoughts on the World Cup, which I'm sure is going to be very interesting to my co-host today, Tom. But let's start, Tom. The ECB is hiking rates into a slowdown. And Rick Rieder yesterday said European bonds are the best place that he wants to buy right now because it's priced for 3 rate hikes. He says there's no way they're going to have 3 rate hikes. They're going to have to cut rates. This was a economic entity that had negative rates for 9 years. They're not going to be able to absorb higher interest costs. It's already slowing the economy, and they're just going to have to cut. So he actually thinks that European bonds are attractive because he's like, it's priced for 3 rate hikes. They're going to have to cut. And we've already got 1 hike today. So thoughts on that, and then we'll talk about producer price inflation.
I mean, I think it's hard to really understand where the ECB is because traditionally you would hike rates if you had too much growth or too much inflation, and they've got not enough of one and too much of the other. And like here, it's mostly driven right now by energy costs. But the problem is if that goes away, then they're going to have made a policy error, in my opinion. I mean, I don't disagree. We talked about it a couple times on the call. At what point do we try and start buying some UK gilts, which is their version of the 10-year, because there have been virtually no times in my career where you could get more on a 10-year gilt than you can get on a 10-year treasury for this reason. I mean, think about at one point during 2022, before the rate hike cycle began, I think it was like 60% of all the bonds in the world were at negative yields. And the only way to make money on a negative yielding bond is if you sell it to someone at an even more negative yield. And now we've had this massive reflation where all of these countries are suddenly at levels where on a relative value, they are now cheaper than U.S. bonds, which should be the case, honestly, because they are of a lower credit quality, lower growth, lower revenue instrument. I mean, if you think about debt, you don't want to pay more for something that makes less, but you know, that's what's happening. You pay less for something that makes less, and that's what they should be. But man, I just don't know how they get out of this quagmire. Europe is it's just a quagmire of garbage. I mean, they have so much restrictive policy. They don't have any control over their own economies because it's all handed down from Brussels. I mean, there's massive unrest. If anybody's been following the stuff that's going on in Northern Ireland over the last week or so, I mean, things have gotten out of control over there, and all of these bad policies are coming home to roost, and now they're hiking interest rates. I think it's a recipe for disaster.
Yeah, I'm in agreement with you, and I think that the long European bonds on the UK side, the gilts, a lot of these things there's only one way I think you can go in terms of interest rates in Europe, because anything higher is going to break the economy. What's crazy is that it's 2.25% now, and we're here in the United States at 3.75, a range of 3.50 to 3.75. So we do have a 30-year auction later today, and it's going to be responding to some of these PPI numbers, the producer price index numbers that we got this morning, Tom, which to my reckoning looks like it came in quite a bit hot.
Yeah, it's kind of an interesting mix because you got hot numbers, but you also got revisions down from last month. So the net effect is really not what you would think. And if you look at what the reaction of the bond market is we're seeing a flattening. So everything 5 years and in is selling off. Everything 5 years and out is up. So you've got basically half red, half green. So if you look at the final month demand, the expectation was 0.6. We came in at 1.1. off a number of 1.4 last month, but last month was revised down to 1.1. So the net increase over the 2 month is really only a 0.1 over expectation. So I would argue that's actually not that bad. So it's like, yes, the numbers are hot, but last month's numbers were hot, but now they're actually being revised cold. If you look at X food, X energy, we actually came in cold on that number. The expectation was to be 0.5%. So you're taking gas out of that and oil. We actually came in cold on everything else. And then last month was 1%, has been revised down to 0.7. So that's actually a net pickup.
Wow.
That's actually a deflationary move on the core. And then so that makes everything kind of murky. And then the year-over-year number came in at 6.5. The expectation was 6.4. But last month came in at 6. They revised it down to 5.7. So we're actually net cold on the year-over-year number as well when taking the two into account. So I think it's a little bit kind of where exactly we are. It's a confusing number because it's like, yes, we have the PPI is up. It is driven by oil. Last month was a surprise big time to the upside. That's now been marked back to moderate. And then that makes this one being hot kind of a wash, I think. So it's like you had two hot numbers, one of them went down, and now it's like you really only have one medium number.
Yep.
So I think that's the way the bond market is reacting to it, which is that what does that say? What does the reaction of the bond market say to me? It says that this is short term. The next 5 years, they're expecting rates to be higher. 5 years and out, they're not expecting that to be higher. That would be indicative of, I don't want to use a dirty word, but transitory inflation, and that this might be the high water mark.
And Rieder was saying exactly that yesterday. So this data exactly supports what he was saying. Essentially, he thinks that he said flat out the Fed should be cutting right now. He thinks that they won't, and so he's positioned. He says the one thing I will tell you is that don't position what you think the Fed should do. Do what you think they will do.
Don't fight the Fed.
So he doesn't think they're going to cut. He thinks that Warsh has a committee that is going to have to take some convincing, and they're not going to do anything, and he thinks it's going to come across pretty hawkish. He thinks that Warsh is going to get rid of forward guidance, and he thinks that that's a very good thing because it doesn't help anything. When you have forward guidance, it locks you in, and also the benefit of having of cutting rates is completely rendered useless, because if the market prices it in before it happens, you can't actually enact any effect, any change when you do end up cutting rates. So his recommendation, and he thinks Warsh is going to do this, is don't provide forward guidance, don't do the dot plot, just make the decision. And he also said, and don't be data dependent. He says that's going to be very controversial, but if I manage money, he says, in a data-dependent fashion, I'd be responding to what happened 3 months ago. I need to go skate where the puck is going, and he thinks that Warsh gets that. But Rieder definitely made the big case that rates should be cut now. He thinks the jobs market numbers are phony. He thinks that underlying jobs numbers are going down. He thinks that AI is really taking a lot of that, and he thinks that inflation's fine. And he says, look, even if inflation was 3%, that's not the systemic inflation that we're concerned about at the Fed. He's like, if you have a single mandate like they do in Europe, which is just prices at 2%, he's like, fine. But here in the United States, you don't have a single mandate. And therefore, let the economy go. The other thing that he said was, you'll want to bring down interest rates because you need to bring down the interest expense. Right now, if the longer that we keep interest rates high, the more it's going to hurt our federal budget. And he said that is something that he is very concerned about.
To your point about skating where the puck is going, you don't buy ExxonMobil a week after we drop the bomb on Iran.
That's why we own Exxon.
Yeah.
Before.
Yeah. And then it's like when that happens, you've got something that's doing well when everything else is not. And the good news is if the Fed does nothing, or even if they hike rates, they're going to cause the data to be bad. And then they will have to cut rates, which is what they need to do anyway. So I'd be more favor of doing nothing versus hiking. But I mean, there's only so much oxygen in the room. And if they continue to do nothing and restrict it, then suddenly you're going to get to a point where you're like, I can't breathe. We're running out of oxygen, and then you have to cut rates and let oxygen back in the room. But that's the thing is, like, it's already leaking out. And they're just like, well, it's not bothering me right now. But eventually you get to a point, and that's when you start to break stuff, is when you make policy errors and you shouldn't be as restrictive as you are because you are dependent on data that is A, wrong, and B, backward looking, and suddenly you run out of air. And there's been times where they've done it incorrectly and everybody passes out before the oxygen gets back in. And then you have to wait for enough oxygen to get back in that everyone regains consciousness, but the longer you go, the more likely you are to end up like Payne Stewart, which is look it up.
Two other comments on that, Tom, with respect to how the Warsh Fed is going to act. If one of the reasons that Warsh might be hawkish too is to keep the long end of the bond curve on the yield curve lower. So if you're hawkish, you're going to be stifling inflation or growth going out in the future, which will keep those rates somewhat contained. So Rieder thinks there's something to be said for that. I did get the sense also that big changes are coming to the Fed. And I think, and he did not say this yesterday.
Good. Feed me.
But I think we're going to go away from, yes, we're going away from the forward guidance, but I also think we're going to go away from the 25 basis point moves, at least on the downside. I think when the Fed cuts, I don't think it'll necessarily be a 25 basis point move. I think it might be a point, it might be 2 points. Just because I think that, if you need to cut, make it meaningful. Like you're not going to boil a frog and hope that stimulates the economy if we're losing jobs every month. You gotta shock you gotta get people out buying houses. He said that every house that's built, every one house that's built creates 3.1 jobs. He says it is the single best job creator in the economy.
And if you can't sell homes and no one can buy a home, then no one builds homes.
Right.
And if the interest rates are too high, that exacerbates the non-building.
Mm-hmm.
I mean, I still am of the camp that, sure, they could cut 1%. Why don't they just open the window by 1%?
Yeah.
So if we're at 3.5, say the federal funds rate is somewhere between 2.5 and 3.5. I guarantee you the next day it's lower, but there are going to be times like, hypothetically, if we drop bombs on a country that no one was expecting, that it would shoot back up to the 3.5. But as oil falls because the conflict tightens and there's a ceasefire, then it drops back to 2.5. And the market could modulate itself based on what's happening, as opposed to we're stuck right here and we're not going to move, and there's going to be no market input on this rate until Jay Powell says so. I mean, that's not how the world works. I mean, the market is modulating itself right now. The market is data dependent or data reactionary. We've seen strong growth. We've seen higher inflation. We've seen jobs numbers, right or wrong, that are higher than expected. And the 2-year, the 10-year, the 5-year have all modulated correctly based on that data. Now, I think we might have overdone it because everyone thinks that inflation is going to spiral out of control. But even now, the spiraling inflation seems to have cracks in it. Even the last 2 days, we've gotten information on that. Oil is at what, 89 today? High 80s, low 90s. That's not going to continue to have 5% month over month change on inflation. PPI or CPI or core PCE, it doesn't matter. It's net lower by a huge margin from where it was a month ago. And therefore, these numbers are going to roll over. And your argument that the 2 years should be at a 4.17, 4.14, wherever it is right now, goes away, and the market will self-correct and it will move down probably to 4 or lower, which means that why are we still sitting at 3.5 on the federal funds rate? Like that's why you either need a more reactionary, more nimble Fed that can cut rates whenever they want to, not every 45 days, depending on whether or not 10 idiots in a room can come to a consensus
by 25 basis
points.
points.
I think the window solves a lot of those problems.
Yeah.
But
yeah,
manage the tails. They didn't try to get me to be Fed chair.
Manage the tails so it doesn't go crazy, and markets don't go nuts. Like make sure that you have a bound, but play with the gutters, but play.
Yeah, exactly. Yeah, they just put in some guardrails, but they can't be 3 inches apart, or the bowling ball will never hit the pins.
He did say lots and lots of opportunities in fixed income. He says, he said one thing because he thinks the Fed should cut rates, but he says, it doesn't help my business because right now, he says, this is just an awesome opportunity for fixed income. He says, in the funds that he's managing, kind of the same thing as us. we're seeing 5-6% yields out there that you can get at very high credit quality. There's 1.5 million securities on the fixed income side, and I think there's like 55,000 equities.
Yeah, I mean,
and many of those equities you can't do anything with.
We talked about it yesterday. There's so much. I mean, there's $1 trillion in credit card debt, and you can buy that if you want. Your default rate is like 7% right now, which is dicey, but you're going to get paid for it, and there's yield there for sure. I mean, it's just a question of where you want to go. And, I mean, we even talk about that with what makes munis so difficult to trade is like, there are hundreds of thousands of different CUSIPs in the muni space, but less than 10% of them trade in any 1 year. And so that makes the price discovery very difficult, which gives us opportunities. I mean, corporates are more liquid, but the bid-ask spreads are wide, and then you get down into private credit, and sure, there is opportunity there, but, it's like fishing in a porta potty, you might catch something, but I don't know if you want to eat it, so that's the landscape right now, but there's there's so much opportunity. I cannot argue enough that like you can lock into future gains, and you might not see a return for 6 months. The bond market has been net down on a price basis across the board for this year. But if you buy it at a high enough yield, you will accrete over time. And if you're going to make 150% on a 30-year treasury, you might not make it in the first year, but then you have 29 years to make 150%. You might be flat 2 years in. Well, all right, well, now you have 28 years, you can make 150%. That number is locked in, assuming there is no default. And, the world is your oyster at that point, because the longer it takes for you to make money on that bond, the more compressed the time period that you will make money on that bond is.
The higher prospective yield.
Yeah, the higher future returns. It's just building. It's like a snowball.
It hasn't gone anywhere. It just moves down the pipe. He did say he's a little bit nervous about near-term equity supply, and this kind of goes to his near-term caution overall. He thinks that there's a lot of supply coming to the market, but he says that buybacks are still very much there, so he thinks that
unless you're Google or SMCI or
right
Oracle, we learned.
Yeah, we're going to talk a little bit more about Oracle here in a second, but he does think that equity markets will probably go higher over the balance of the year, but the next couple of months might be a little bit tricky. On the economy side, he says the biggest thing that he'd be concerned about is if our nominal growth goes down, because if our nominal growth goes down, then all of a sudden the debt becomes even more important. So he thinks that we need to continue to run it hot in order to pay down that debt and improve our ratios there on the interest expense line, which I would agree with. And he thinks that he's concerned about inflation coming down and rapidly, and I think he's concerned about economy slowing. So
smart guy.
That's going on with that. On the equity issuance, Oracle did say that they're going to raise about $40 billion. Combination of debt and equity, but it sounds like it's more likely that it'll be more equity. So again, this comes on the heels of SMCI. It comes on the heels of Google raising 90. Google ended up upsizing it to 90 billion.
Great.
So then we got SpaceX coming. I guess tonight it'll price, and then tomorrow we start trading. Bear in mind, it's not going to trade at 9:30. It probably won't trade at 10:30. It might trade around 1 o'clock. So keep that in mind on SpaceX for tomorrow. But Oracle now anticipates $90 to $95 billion in CapEx in the coming fiscal year, just $90 billion in revenue. So a lot of times we talk about plowback rates, which is the percentage of operating profit that gets redeployed into capital spending. This is, and usually, it's kind of a 20 to 30% plowback. That's of operating profit. So as a percentage of revenue, it's about 10%. They're about ready to spend over 100% of revenue on CapEx. And so the market didn't like that. The stock's down about 10%. pre-market, and this comes with OpenAI considering, quote, significant cuts to token costs. And I think this is a big concern because it means that maybe we have too many supplies of, why would you cut? We have too much supply of tokens and not enough demand. That's why you cut the price. But if tokens is what you measure GPU throughput and AI usage in, it's the first indication to me that maybe we're overbuilding, and we're getting some real signs that we're overbuilding in AI. The fact that they're having to cut prices on tokens. Now, this was always going to happen because that's what happens. You know, as you get better at things, you can deliver it at a lower cost. I mean, the first iPhone would probably be worth like $20 these days because it doesn't have very good tech in it. It's not as capable. So the token cost should come down over time. But they said, and according to the Wall Street Journal report, they said OpenAI is considering drastically lowering the prices. So this is dangerous.
Especially if you're trying to IPO, you know, because if you start lowering prices, you're going to make less money. Mm-hmm. I mean, that's just the name of the game. And then, so you've got this $1 trillion IPO. You're going to be the biggest, baddest company. I mean, think about SK Hynix. It's like, or Micron or AMD. There's this unbelievable demand for all these chips. They're just paying through the nose for these things. Well, suddenly we're going to start cutting our prices. We don't actually need to buy any more of your chips. And these companies that were not making money go back to not making money really quickly, and they could fall by, 60% in the same period of time that they grew by 60%, which was days.
And it's coming on the heels of all this accelerated CapEx. So on the same time you're spending more money, all of a sudden you might get less money for that. That's not a good return on investment. So I think that's also not helping Oracle this morning. I do have an infographic that I built on Gemini. I don't know if we have the capacity to go through this today. We can talk a little bit about it quickly, but essentially I looked at, a lot of people are saying it doesn't matter whether you raise the cash from equity or debt, and the fact that Google's raising equity is not such a big deal. I would disagree with that for this reason. If you bought a house and you bought a house for $240,000 and it was a great buy and you're charging $4,000 a month, you're getting a 20% return on that investment. If you actually use some debt on it, you could actually get a 30% return on investment. So it would be better not to use 100% equity. The only reasons that you would want to only use equity is if you can't put together the financing deal. You actually expect lower return on invested capital. So that's like that third chart here. Or you don't know what the return on invested capital is. You don't know what the useful life of the equipment is going to be. You don't know what the residual value of the GPUs are going to be. You don't know the operating costs. I mean, remember for the first 3 years of AI, we were talking about operating costs and how energy is like the bottleneck, and that's going to really degrade profitability. No one talks about energy anymore, but that is a real cost. Just because you're able to buy a CapEx and immediately rent it out and form revenue, you still have energy costs associated with that. And then you also don't know what the value of the tokens is going to be. And OpenAI cutting prices is is dangerous. So that's why you would use equity if you don't know the return on invested capital. And there's a lot of confidence out there that the returns are great, but I don't think anyone really knows. And they're kind of showing their hand by issuing equity and not debt.
But if they aren't great, your margin for error is much smaller.
Yep.
And that's the real takeaway.
Because leverage works both ways.
Yeah. And if you are an equity holder and that hurdle is not met, then you have nothing. Mm-hmm.
And it's just, it is interesting to me, though, because they're so confident of their view that the returns on investment are so high, but they just don't know.
Talk about backward looking.
Yeah.
They have been.
Yeah.
That doesn't, past performance is not indicative of future results. You'll find that, I'm assuming, in our disclosure that goes at the end of this video every single time.
So it's something interesting to think about as we see some of these deals. Now, SpaceX, for example, obvious why they're raising equity. You have no idea what the returns are going to be, but for Google, if you're claiming you know what the return's going to be, you should probably.
What does it cost to build a space station on the moon? I don't know, but $80 billion is a good start.
Yes. All right, World Cup. I think most interesting groups are Group D, which the USA is in, Paraguay, USA, Turkey, and Australia. I really think it's anyone's. I think
Turkey, eh?
Yeah, I think
modern parlance.
I think Turkey's probably the favorite in that group, but I actually have Paraguay winning it and the USA coming in second. I think the US is. I'll talk about them in a minute. Group I is also very interesting. You got France, who have some of the most exciting, fastest players on the planet. You have Norway, which is a golden generation. This is only their 4th World Cup. Interesting team. Senegal, who beat France when they were the defending champions in 2002, famously, and then Iraq. In terms of the host expectations, I think Mexico is going to lose to England in the round of 16. USA is going to lose to Argentina in the round of 16, and Canada is going to lose to the Netherlands in the round of 16. But I do think that the U.S. is going to do better than a lot of people think. I think that after not qualifying for the last World Cup and people kind of being out on U.S. soccer, I think they're going to have a miracle or two. And I actually don't think it's impossible to beat Argentina if they play. So that's something to watch.
I would say that my biggest takeaway in the World Cup, as we learned yesterday, someone in the office didn't know how to say the country name of Paraguay, and maybe had never said it out loud or didn't know about it.
Who's this?
I'm not going to blow him up on air, but Sam came back and was like, I can't believe it, but so-and-so said Paraguay as if they had never said that out loud before in their life. And I said, and he clarified with this person, you mean Paraguay? And he said, what is it? It's not Paraguay? Which is shocking to me. Absolutely blew my mind, but we don't need to air out our dirty laundry on this podcast.
I'm guessing I think I know who it is. Oh, interesting.
Incredible stuff.
That is wild.
So.
Good thing that we're not geopolitical analysts here. Cinderella story, I think, will be Norway. I have them losing to England in the quarters. This is only their 4th World Cup, first since '98, and for the winner, France.
I like that. I'm fine with that.
So the French need something to go right for them because they don't have anything good going domestically.
No, but prayers up for the Eiffel Tower after Paris Saint-Germain won the Champions League or whatever.
Yeah,
there was mass destruction of property.
What's the view from your Irish relatives, or maybe Irish relatives, on
what they're going to do in the World Cup?
Like who are they supporting? Because Ireland's not in it.
I would guess Scotland. It's wild that Scotland got in.
Yeah.
Shout out to my buddy Ryan. He's in Foxborough right now.
Because they're not England.
No,
fans.
never England. They do have some. People forget the Gaelic. What Irish would call Irish and what Scottish would call Gaelic is the same language, but it's split like the swallows for Darwin, where they've evolved slightly differently. Those are theoretically the same people. Scotland, most people don't know, has the largest percentage of gingers worldwide because because that's basically where it came from. These people were going back and forth for a very long time. One is more willingly subjugated to the crown, and one is less willingly subjugated. So I would say my guess would be there's probably some leaning from the Irish towards the Scottish, if I had to guess.
All right. On that note, have a great day. We'll see you tomorrow. Bye.